What if I told you that we are currently witnessing a financial anomaly that should theoretically be impossible? As the markets reopened following the Christmas holiday in late December 2025, the price of silver did not just climb, it went vertical. We are talking about a surge that shattered the psychological ceiling, pushing the metal between $75 and $79 per ounce. To put this in perspective, this represents a staggering 157% gain year to date and a 9% surge in a single trading session. But have you asked yourself why the most suppressed asset in history has suddenly decided to break the chains of the banking system right now? But if you look closely at the screens, you will see something that should send a chill down the spine of every central banker in the West. There is a massive, gaping disconnect between the price of silver in Shanghai and the price of silver in London and New York. Right now, silver is trading for roughly $82 to $83 per ounce on the Shanghai Gold Exchange. Meanwhile, the Western spot price is lagging behind, struggling to catch up in the mid-70s. This creates an arbitrage gap of nearly 10%. In a healthy, functional global market, high-speed trading algorithms and arbitrageurs would close this gap in milliseconds. They would buy the cheap silver in New York and sell it in Shanghai until the price is equalized. The fact that this gap remains open and is widening tells us one undeniable truth. The Western paper markets, the Comex and the LBMA, have lost control over physical price discovery. The arbitrage cannot be closed because there is no physical metal available at the Western price to ship to China. We are not just watching a bull market. We are watching a market break. We are watching the great decoupling of East versus West and physical reality versus paper promises. This is the moment the financial system has feared for 45 years. It is a signal that we are entering a period of extreme turbulence and chaos that will likely persist through 2027. Today, we're going to connect the dots between a 45-year technical pattern, a run on physical vaults in Asia, and a macroeconomic reset cycle that is mathematically due to strike right now. To understand the violence of this move, why silver is exploding by $3 or $4 in a single day, we have to zoom out. We are not looking at a daily chart or even a yearly chart. We are looking at a technical structure that has been building since 1980. Market analysts call this the cup and handle formation. It is one of the most reliable, explosive patterns in technical analysis, and this specific one is historic in scale. Picture a cup. The left rim of the cup is the high of 1980, where silver hit $50 an ounce. The bottom of the cup spans the long bear market of the 1990s and early 2000s. The right rim of the cup is the peak of 2011, where silver once again touched $50. For the last 14 years, from 2011 to 2024, we have been forming the handle, a period of consolidation and downward pressure. In October of 2025, we officially broke out of this 45-year structure. When a formation this massive finally resolves to the upside, the release of energy is akin to a dam breaking. Technical analysis dictates that the target price is determined by the depth of the cup. Based on this 45-year setup, we are not looking at $75 as a ceiling. We are looking at technical targets of $100, $150, or even higher in the immediate future. However, there is a dangerous misconception floating around mainstream financial news right now. You will hear pundits say that silver is at an all-time high, while $75 or $79 is technically a record in nominal terms, meaning the number printed on the currency. It is a lie in real terms. If we adjust for inflation using the government's own CPI calculator, the $50 high from 2011 is actually equivalent to roughly $72.06 in purchasing power today. We have only just cleared that modern era hurdle, but the real story is 1980. If we adjust the 1980 high for inflation using the official CPI metrics, silver would need to be over $145 per ounce just to break even in purchasing power. If we use the shadow statistics, using the inflation metrics that were actually in place in 1980, the real high would be closer to $744 an ounce. This means that despite the euphoria, despite the 157% gains this year, silver is arguably still cheap. We are nowhere near the inflation-adjusted mania of the past. Furthermore, we must look at the gold-to-silver ratio. This is the number of ounces of silver it takes to buy 1 ounce of gold. For most of modern history, this ratio has hovered high, often over 80 to 1. Recently, this ratio has collapsed below 60 to 1, hitting 57.7 to 1. When this ratio breaks down, it signals that silver is moving into a phase of massive outperformance relative to gold. In previous precious metals bull markets, this ratio has compressed to 40 to 1, or even 15 to 1. If gold holds steady at $4,500 and the ratio returns to 15 to 1, do the math. The upside for silver is not just a few percentage points. It is multiples of the current price. While the charts provide the roadmap, the engine driving this move is physical scarcity. We are seeing a phenomenon that can best be described as a physical squeeze centered in Asia. China is the second largest silver producer in the world. They are also the #1 importer. For the last 15 years, China has been methodically absorbing the global silver supply. Now we are seeing reports of panic. The silver LOF fund in China has hit its limit-down mechanisms due to excessive speculation, while premiums on physical metal are exploding. Why is China panic buying? It is not just retail investors chasing a hot stock. There is speculation that China is engaging in a strategic resource play. They control the rare earth metals needed for high-tech manufacturing. By cornering the silver market, a critical component for solar panels, electric vehicles, and advanced electronics, China secures the supply chain for the next industrial revolution. Remember, new export restrictions are set to kick in around 2026. This looks like a frantic bid to secure physical inventory before the doors close. This demand is visible on the streets. We are seeing images from Japan showing lines of over 200 people queuing up outside major bullion dealers like Tanaka Kikinzoku in the Ginza district, hours before the store even opens. We are seeing similar reports from Bullion Star in Singapore. This is a run on the bank, but the bank is the bullion vault. The Japanese citizens, watching the yen collapse, are fleeing paper currency for hard assets. This physical demand is breaking the Western pricing mechanism. We are seeing stress signals from the London Bullion Market Association, the LBMA, and the Comex in New York that we have never seen before. There are leaked reports, credible enough to be taken seriously by top analysts, that the LBMA is refusing to renew silver leases. In the precious metals world, institutions often lease silver to maintain liquidity. The report suggests that the LBMA has told counterparties that leases expiring in the next 2 weeks will not be renewed at any rate. This is the equivalent of a rental car company calling you and saying, "I do not care how much money you offer to pay. Bring the car back today." It implies they simply do not have the metal to lend. Further compounding this is the data from the Comex. On Christmas Eve, during a holiday exchange outage, a massive 1.66 million ounces of silver were withdrawn from the vaults. This metal is leaving the registered category, which is available for delivery, and disappearing into private hands. This creates a chaotic market state that some are calling backward tango. Usually, markets are in contango, or backwardation. Right now, the market is flipping violently between the two, while the spread between London and Shanghai blows out. This is a sign of a market suffering a cardiac arrest. The paper market says one price, but the physical market is screaming that the metal is gone. As capital flees broken currencies and broken bond markets, it has to go somewhere. For the last decade, that capital flowed into big tech and cryptocurrency. Now we are seeing a historic rotation, a great wealth transfer from digital promises to tangible reality. Silver has achieved a milestone that would have seemed laughable just 2 years ago. With a market capitalization now hovering around $4.4 trillion, silver has become the third largest asset in the world by market cap. It has surged past corporate giants like Apple, Microsoft, and Google. Currently, the only assets standing above silver are gold, which sits at over $17 trillion, and Nvidia at roughly $4.6 trillion. There is a profound irony here. Nvidia, the poster child of the AI revolution, requires silver to function. You cannot have high-performance chips, AI servers, or green energy infrastructure without silver's conductivity. Yet the monetary value of silver is chasing down the very companies that depend on it. If silver overtakes Nvidia to become the second most valuable asset on Earth, it will trigger a psychological shift in the mainstream investment community that we cannot quantify. We are also seeing a decoupling from Bitcoin. For years, Bitcoin was touted as digital gold. While Bitcoin is still trading at high levels, over $80,000, it is showing weakness relative to the explosive moves in precious metals. When silver was in the 40s, Bitcoin was over $100,000. Now silver is 75, and Bitcoin has not kept pace. We are seeing evidence of speculative capital rotating out of the digital gold narrative and back into the original gold. We see cases like Baronaire David Bateman, a billionaire who publicly announced he has purchased 1.5% of the entire global 2025 silver mining output. His rationale is simple. Looking ahead to the economic conditions of 2026, he prefers an asset with zero counterparty risk over a digital asset or a fiat currency. This is the behavior of smart money. They are front-running the realization that in a crisis, you want the asset you can hold in your hand, not the asset that lives on a server or a ledger. Why is all of this happening now? Is it just supply and demand? No. It is the turning of a massive macroeconomic cycle. If we look at the Dow to gold ratio, which measures how many ounces of gold it takes to buy the Dow Jones Industrial Average, we see a cycle that repeats with frightening regularity. We had a reset in 1933 during the Great Depression. The ratio collapsed, and financial assets were flushed out in favor of hard money. Then we had the next major reset in 1980. The ratio hit 1 to 1. 1 ounce of gold could buy the Dow Jones. Now, do the math. From 1933 to 1980, is 47 years. If we add 47 years to 1980, where do we land? We land exactly in 2027. We are currently standing on the precipice of this cycle's conclusion. The ratio is falling. We are currently around 10 to 1. If history repeats, or even rhymes, we could see this ratio return to 1 to 1, or perhaps 0.5 to 1. This implies one of two things, or a combination of both. Either the stock market collapses by 90%, or the price of gold and silver rises to astronomical heights to meet the Dow. Given the money-printing habits of global central banks, a nominal collapse in stocks is less likely than a hyperinflationary rise in metals. This cycle is being accelerated by the global debt crisis. The United States national debt is currently $38.5 trillion. By 2029, it is projected to hit $45 trillion. The deficit, the amount we overspend every year, is nearly $2 trillion. To put this in perspective, in 1980, when silver hit its previous peak, the total national debt was less than $1 trillion. Today, our annual deficit is double the entire national debt of 1980. Critics will argue that debt does not correlate to gold prices. They will point to the period from 2011 to 2019, where debt rose and gold fell. And they are right to a degree. Debt alone does not drive gold, but trust drives gold. We have reached a point of peak debt where the geopolitical consequences of that debt are manifesting. Central banks are not buying gold because they care about the U.S. debt-to-GDP ratio per se. They are buying gold because the United States weaponized the dollar against Russia, seizing assets. That broke the trust. When trust in the sovereign bond breaks, the liquidity flows to the only neutral reserve asset in the world, gold. And silver, as gold's volatile little brother, follows that path with even greater velocity. Now, I need to take off the bull hat for a moment and put on the analyst hat. It is easy to get swept up in the euphoria. We are seeing social media posts about wives finally congratulating their husbands for hoarding silver in the basement. We are seeing a demographic, mostly 86% male, high-fiving each other in an echo chamber. When everyone is celebrating, that is usually the time to be cautious. We must remember, China is not just a buyer, they are a producer. If the price gets too high, or if it serves their strategic interest to crash the market to hurt Western speculators, they have the inventory to flood the market, at least temporarily. Furthermore, markets do not move in straight lines. A vertical move like we have seen, 9% in a day, 43% in a month, often invites a sharp, violent correction. This is what we call a liquidity flush. If the stock market crashes in 2026 due to the debt crisis, silver will likely sell off initially as investors sell everything just to raise cash. If you are sitting on massive gains, if you have doubled your money, there is no shame in taking your initial investment off the table. This is what professional investors call playing with the house's money. The goal is to survive the volatility. However, the fundamental thesis remains. We're buying insurance against a currency event. If you are selling your silver, what are you buying? Are you moving back into dollars? Into bonds? Into a stock market at all-time highs? That is the dilemma. Before we conclude, there is one final, critical pillar to this thesis that often gets ignored by the gold bug community, but is arguably the most important factor for the long-term price floor. We have talked about monetary demand and the breakdown of trust, but we haven't deeply examined the industrial vice that is squeezing the global supply chain. Major banking institutions like UBS are now projecting a massive silver deficit for the coming year. Estimates are circling around 300 million ounces. To be clear, a deficit this large means the world is consuming silver significantly faster than it can dig it out of the ground. And here is the kicker. We have been in a structural deficit for 5 consecutive years. We have been eating into above-ground stockpiles, and those stockpiles are now running on fumes. But why does this matter for the price? It matters because of a concept called price inelasticity. In the retail world, if the price of beef doubles, you might switch to chicken. That is price elasticity. But in the industrial high-tech world, silver has no substitute. It is the most conductive metal on the periodic table. If you are Apple and you need a tiny amount of silver for an iPhone, or if you are Raytheon building a Tomahawk missile, or a solar manufacturer rolling out panels for a government-mandated net-zero grid, you must have silver. Here is the reality. The amount of silver in an iPhone costs pennies, even at $75 an ounce. If silver goes to $150 or even $300, the cost of manufacturing that phone only rises by a negligible margin. Apple will not stop making iPhones because silver tripled in price. They will just pay the bill. The same applies to the defense industry. Do you think the Pentagon cares if the silver in their guidance chips costs $50 or $500? They don't. They care about performance and availability. This creates a class of buyer that is completely insensitive to price. They are the inelastic bid. As the monetary investors, the people fleeing the dollar, compete for ounces, they are running head first into industrial giants who cannot stop buying. And this demand is colliding with a supply cliff. You cannot just flip a switch and produce more silver. Mines are depleting. Yield grades, the amount of silver found per ton of rock, are falling globally. It takes, on average, 10 years to take a new mine from discovery to production. Even if silver hit $200 tomorrow, it would take a decade for new supply to flood the market. We are also witnessing a green energy feedback loop. Governments around the world are printing trillions of units of currency to fund the green transition: solar, wind, EV infrastructure. All of this requires billions of ounces of silver. So they print fiat currency, which causes inflation, to buy silver-intensive technology, which drives up the demand for silver even further. It is a self-reinforcing cycle that guarantees a floor under the price. So while we might see speculative washouts and volatility, the industrial reality puts a hard, concrete floor under this market. The days of $20 silver are likely gone forever, simply because the world of high-tech manufacturing cannot exist without it, and they are willing to pay whatever the paper market demands to keep their factories running. So, where do we go from here? We have a convergence of three irresistible forces. First, the technicals. A 45-year cup and handle pattern that is broken out, targeting triple-digit silver. Second, the physicals. A run on vaults in Asia and a depletion of Western inventory that is breaking the pricing control of the LBMA and Comex. Third, the macro. A 47-year reset cycle that points directly to a climax in 2027, fueled by a sovereign debt spiral that has no mathematical exit. We are entering what can only be described as turbulent and chaotic times. The great decoupling is here. The price you see on your screen in New York is becoming irrelevant because you cannot get the metal for that price. The real price is being discovered in Shanghai, in the back alleys of Ginza, and in the premiums charged by dealers who actually have stock. The next 2 years will likely see the destruction of the current paper pricing mechanism. We may wake up one morning to find that the Comex has declared force majeure, settling contracts in cash because they have no silver to deliver. In a world of $45 trillion in debt and broken promises, the greatest risk is not the volatility of silver. The greatest risk is holding the asset that is someone else's liability. The greatest risk is not owning the one thing that has survived every financial collapse in human history. Stay liquid, stay alert, and keep your eye on the spread. Because when the dam finally breaks, It won't matter what the spot price says. It will only matter what you hold in your hand. See you on the next one.